Topic 4. Banking. How banks quietly create economic growth. The story of how idle money becomes the engine of civilization. The village of locked boxes. In a town called Devpur, people worked very hard. Farmers grew crops. Carpenters made furniture. Women stitched clothes. Shopkeepers sold goods. Every family tried to save money. But there was one big problem. People did not trust anyone. So they hid money under pillows, inside rice containers, beneath floor tiles, inside metal boxes. At night, people slept in fear. Fear of theft, fire, loss. Money existed, but economy was still weak. Meet Suresh the farmer. Suresh worked honestly for years. Slowly he saved 50,000 rupees. His dream: buy better seeds, rent extra land, increase farming. But he feared, what if thieves steal my savings? So he hid money underground. Now think deeply. Suresh's money was sleeping, not helping anyone, not creating growth, not creating jobs, just lying silent under soil. The first great banking idea. One wise old merchant observed something. He realized thousands of people are saving money, but that money is not moving. So he created a safe house for money. People deposited savings there. That safe house later became a bank. What banks really do? Most people think banks only keep money safely. No, that is only surface level understanding. Real truth: banks take idle money and make it productive. That is the heart of banking. The transformation begins. Now Suresh deposited 50,000 rupees in bank. Nearby lived Rafiq the carpenter. Rafiq had skill, hard work, dreams, but no money. He wanted to buy machines, hire workers, expand business. Bank saw opportunity. It gave loan to Rafiq. Now, Suresh's sleeping money became Rafiq's working money. This is the miracle of banking. One person saves, another person borrows. Bank becomes bridge between savers and dreamers. Without banks, savings remain dead. Businesses never grow. Economy moves slowly. What happened next? Rafiq bought machines, then hired 5 workers, increased furniture production, sold to nearby towns. Workers earned salaries. They bought food, clothes, school books. Now many businesses benefited. One loan created chain reaction across economy. This is called economic multiplier effect. Then comes interest. Suresh asked bank manager, "Why should I keep money here?" Bank replied, "We will pay you extra money." That extra reward is interest. Real meaning of interest. Interest is rent paid for using someone else's money. Just like house rent for using house, bike rent for using bike. Interest is money rent. Why borrowers accept interest? Rafiq borrowed 1 lakh rupees. Why agree to repay more later? Because he believed business growth tomorrow will be bigger than interest cost. Good loans create future income, future productivity. But then greed entered. One day banks became overconfident. Managers started giving loans carelessly. Loans given to corrupt businessmen, politically connected people, weak projects. Some borrowers never repaid. Now banks faced bad loans. These are called NPAs, non-performing assets. The NPA crisis story. Bank manager became nervous. Depositors became scared. People asked, "Is our money safe?" Bank had a problem. Remember, banks lend depositors money. If too many loans fail, bank weakens, trust weakens, economy suffers. Why banking runs on trust? Think deeply. If all depositors suddenly demand money together, most banks cannot pay immediately. Why? Because money has already been lent out. So banking survives because people trust the system. The bank run disaster. One rumor spread. Bank may collapse. People rushed, shouting, panicking, demanding cash. Even healthy banks can collapse if fear spreads too fast. Because fear moves faster than money. Then RBI enters the story. RBI acts like guardian of banks. It checks bank behavior, controls lending, protects depositors, prevents panic. RBI knows if banks collapse, entire economy can freeze. How banks create economic growth. Without banks, factories don't expand, farmers can't invest, Students can't study. Businesses stay small. Banks quietly fuel investment, employment, innovation, growth. They are like invisible engines of economy. But too much lending is also dangerous. Suppose banks give loans too easily. People borrow excessively. Houses, luxury items, speculation. For some time, economy looks booming, but later, debt becomes heavy, defaults rise, crisis begins. That is how many financial crises start. The biggest banking truth. Good banking creates prosperity. Careless banking creates disaster. That is why banking is built entirely on trust, discipline, and confidence. How UPSC toppers write this. Not banks accept deposits and give loans. Instead, banks mobilize idle household savings into productive investments, thereby enabling capital formation, employment generation, and economic expansion while simultaneously operating on systemic trust and financial discipline. That is understanding. Final memory line. Never forget this. Banks do not create wealth from paper. They create growth by moving trust from savers to producers. If this sentence stays in your heart, you understand banking deeply. Next topic, interest rate, the accelerator and brake of the economy. You will understand RBI policy, repo rate, inflation control, slowdown, recession, borrowing behavior, monetary policy, through one connected story of a speeding village economy.